With 2023 coming to an end, it's time to start repositioning our portfolios for what's to come in 2024. We saw robust growth in 2023, largely from the technology and communication services sector, which are led by Meta Platforms and Alphabet. Here's a look at the Magnificent Seven's year-to-date returns so far this year. NVIDIA led the way, climbing 240%, followed by Meta Platforms, climbing nearly 200%. Tesla saw their stock price increase 105%, Amazon 82%, Alphabet nearly 60%, Microsoft 57%, and Apple bringing up the rear with only 49%. And I say only 49% as a joke because that's a phenomenal rate of return, especially from a company with their size and magnitude. Turning our attention to 2024, the Federal Reserve has already told us they plan to cut interest rates, not just once, but multiple times, which can lower borrowing costs, but this also coincides usually with slower economic growth. But that lower borrowing cost could be, for certain sectors, a tailwind for some of those companies. As such, in today's video, I'm going to look at 3 ETFs not named SCHD that I love heading into 2024. But before we begin, do me a huge favor, click that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into today's video, taking a look at 3 ETFs not named SCHD that I love heading into 2024. If you've watched this channel before, then you've seen I've done a number of videos on SCHD, a core holding of mine. I love them for their diversified portfolio, but one thing they're lacking is a lack of exposure to technology and communication services, the top 2 performing sectors in 2023. Hence the underperformance this year. But if we get a broadening like I expect at the back end of 2024, SCHD is going to do just fine. But this video isn't about SCHD. This is about 3 other ETFs that I love heading into 2024. Beginning with ETF number 1, which is the WisdomTree US Quality Dividend Growth ETF, stock ticker DGRW. Over the past year, DGRW has done pretty decent, up 17%, which on a normal year is great performance. But in 2023, it underperformed the S&P 500, which is up about 26%. DGRW has more than $11 billion in assets under management. The ETF has an expense ratio of 0.28%, which is still on the low end. I usually look for funds with expense ratios below 0.5%. Expense ratios are things you need to be mindful of when investing in ETFs, index funds, or mutual funds. Think of these as the fee that you have to pay for managers to manage the portfolio. More actively managed ETFs are going to have usually higher expense fees. More passively managed ETFs are going to have usually lower expense fees. DGRW is an ETF that has grown on me a lot over the past 12 to 18 months. They have a diversified portfolio and a strong exposure rate to the technology sector, hence the strong performance in 2023. Here's a look at the sector breakdown, where you will see technology as the highest sector with 28.6% exposure, followed by healthcare at 17%, industrials 13%, financials 12%, and consumer defensive at 11%. Those top 5 sectors account for more than 80% of the entire fund. Now let's look at the top holdings in DGRW, led by Microsoft at 7.5%, Apple at 5%, Johnson & Johnson lower than 4%, with AbbVie at roughly 4%, Broadcom at 3.6%, the Home Depot at 3%, Procter & Gamble at 3%, the Coca-Cola Company at 2.7%, followed by PepsiCo at 2.3%, and rounding out the top 10 is Cisco Systems at 2.2%. A lot of high quality holdings, and these top 10 positions account for 36.5% of DGRW, and the ETF invests in 300 total stocks. So as you can see there, a very well-rounded ETF with a higher exposure rate to technology. So if you're still looking for that technology exposure, this is a great ETF to look at. You also get a dividend, you get dividend growth, high quality blue chip companies. So again, You could get the technology, but still have broad exposure to other sectors as well if we do get that broadening out in 2024. Before we move on to the next ETF, let me take a moment to tell you about the Investor's Edge, my weekly newsletter that has both a free edition as well as a paid edition. Premium subscribers not only get the weekly wrap-up, which goes through what happened in the week prior, but in addition to that, you also get my entire portfolio. I do a monthly portfolio update, all the stocks I bought, all the stocks I sold during that particular month. You also get a stock deep dive, an in-depth research report every single week on one individual stock. In addition to that, you get our weekly Edge report as well as earnings recaps. I'll leave a link down in the description below for you to sign up and become a premium member today and start getting an edge in the market. That leads us to ETF number 2, which is the Pacer US Cash Cows 100 ETF. Stock ticker COWS or COWZ. That's probably one of the best ETF or stock symbols on the market today. If you have watched any of my prior videos before, then you know the fact that I love free cash flow. I always say free cash flow makes the dividend grow. But regardless of whether you're investing in a dividend stock or a growth stock, free cash flow is important because it gives management the flexibility to do what it needs to continue growing. Free cash flow is where the dividend is paid. Free cash flow is where debt paydowns can come from. Free cash flow is where acquisitions can come from, so on and so forth. Free cash flow adds so much flexibility to a company. Over the past 12 months, COWS has generated returns of nearly 15%, and they have expense ratio of 0.49%, barely meeting my 0.5% or lower requirement. The ETF has $18.4 billion in assets under management. So when it comes to the makeup of this ETF, Cash Cows, it's pretty much as its name says. They're looking for high-quality companies that generate strong amounts of free cash flow. So what they do is they screen the Russell 1000 looking for the top 100 in terms of free cash flow yields. Morningstar rates the ETF 5 stars as it's a great way to add exposure to mid-cap companies. The ETF is well diversified, but a little more top-heavy with higher exposure to sectors like energy and consumer cyclical, which account for 28% and 20% of the fund, respectively. The next largest sectors include healthcare at 14%, materials at 12%, and industrials at 11%. Now let's have a look at the top 10 holdings, which is going to look different from the last ETF we just looked at. The top holding is CVS, followed by DR Horton, Booking Holding, Lennar, Qualcomm, 3M, AbbVie, Valero, Chevron, and Phillips 66. Not much sway between the 10th position and the top position, which is 2.2% down to 2%. So as you can see with this ETF, there's a lot less emphasis on growth and more of an emphasis on stability and high quality companies. So if we do fall into that rut, that economic rut in 2024, especially early on, like I'm expecting, then this could be a great way to play that moving forward. The cash cows, companies that can continuously generate strong amounts of free cash flow. That leads us to ETF number 3, which is the Invesco S&P 500 GARP ETF. Stock ticker SPGP. So we've looked at a dividend ETF. We've looked at the cash cows ETF, which is more about stability. Now let's look at an ETF that gives us the option for a little more growth. Invesco is the same company that produced the popular QQQ ETF. And for those of you wondering what in the world GARP means, it stands for growth at a reasonable price. Looking for a good mixture of companies, high quality companies that offer great growth potential, but aren't trading at extreme valuations. They actually offer growth potential, but are trading at reasonable valuations. The SPGP has performed quite strong in 2023, up 21% over the past year, about in line with the S&P 500. The ETF has an expense ratio of 0.34% with $4.4 billion in assets under management. In terms of the sector breakdown, energy and technology are the top sectors, accounting for 25.2% and 22.5% respectively, followed by materials at 13.5%, industrials at 10%, and consumer cyclical at 8%. So again, more top-heavy like cows. Energy being the top sector will play out through the top holdings, as you will see here. And the top holdings include Diamondback Energy, Enphase Energy, CF Industries, Steel Dynamics, Nucor, The Mosaic Company, Albemarle, Marathon Petroleum, Vertex Pharmaceuticals, and Coterra Energy, all ranging from 2.1% exposure to 1.8% exposure. so pretty tight among the top positions, with the top 10 only accounting for less than 20%. In total, SPGP has a total of 77 positions. Given the run-up in the price of SPGP, given that the S&P 500 has been rising, it's probably a name that I'm not looking to buy right this instant, but it doesn't change my love for the ETF. That means it's high on my watch list. If we get a pullback, which creates more of an opportunity for an ETF like SPGP, this is going to be a name I'm going to be looking to add to my portfolio moving forward. So that does it for our 3 ETFs that I love, not named SCHD. We had DGRW, which is a dividend growth ETF. We had the Cash Cows ETF, looking at high-quality companies that produce strong amounts of free cash flow. And then we had our GARP ETF, growth at a reasonable price, giving you a mix of growth at a reasonable price. Down in the comments section below, let me know which of these 3 ETFs do you like heading into 2024. Do you own any of these ETFs? I would love to know down in the comments. And if you haven't done so, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.